In this presentation, we will compare and contrast the cash and accrual system. In other words, we've ran the accrual system for January in our bookkeeping system, and then we used a cash basis system depending solely basically on the bank feeds in March. And so now let's compare and contrast the income statement, the timing statement between those two methods. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. Let's go down to the reports on the left-hand side and open up our two favorite reports, that being the balance sheet report. Opening up the balance sheet. I'm going to change the dates up top. I'm going to be changing it from 01/01/20 to 03/31/20. So January through March. I'm going to run that report. Then I'm going to right-click on the tab up top. I'm going to duplicate that tab. Then I'm going to go back to the tab to the left. We're going to go back down to the reports. And we're going to be taking a look at the profit and loss and report, the P&L, the income statement. Scrolling back up, we're going to be running the same period from January 1st to 03/31/20. Then we'll run that report. Then I'm going to duplicate that tab up top, right-clicking on the tab up top, and duplicate it. Then let's go back over to the balance sheet on the right-hand side, back to the balance sheet on the right. I'm going to close up the hamburger. Going to hold down Control, scroll up just a little bit to get back up to that 125 range. Now, this is the balance sheet as of March 31st. Note that the balance sheet is permanent accounts. Therefore, when we think about the balance sheet, it's the accounts don't roll over. This isn't a performance report. They're as of a point in time. Let's compare. Let's do our analysis. We have the range from January to March. Let's change this total column to months. So I'm going to select the total column and instead go to months down below and then run that report. And now we have our comparison. So we're really looking at January and March because we entered the same data in essence in January and March. Now, when we think about the balance sheet, remember that doesn't roll over. So it's not like January started with no data in it and March obviously had data in it. So we can't do the same kind of comparison as we can possibly for the profit and loss. But we want to be thinking about the data from on January and the data for March, where we basically did the same kind of activities on more of a cash basis for March, on more of an accrual basis for January. Let's do the same thing for the P&L. This is where we can do most of our comparison over here. We're going to go back up top. I'm going to change the total column to the months column and then run that report. And here, the income statement rolls over into the balance sheet. So when we think about January on the income statement, we're thinking about what was the performance in the case of revenue, how much revenue did we generate from January for the month of January, from January 1st to January 31st, which then rolls over into the balance sheet to retained earnings or capital account. And that is going to be kind of a direct comparison that we could see for March, how much income did we generate or earn in March. So let's first consider the income items. Now, on the income items for January, we had the sales, and then we had the sales of products. When we sold our income for March, we basically assumed that we all had the same kind of sales. And if you have different types of sales, like if you sell products and services, that's going to make the cash basis a little bit even tougher because then you're going to have to, if you have to deal with sales tax, you want to break out the cash sales and the service sales, so you can basically break out the sales tax. We put everything into sales of products and services just so we can basically look at the more complicated situation where you have to deal with sales tax and how you might start to think about how to consider working sales tax into a cash basis system. Now, we have a lot more revenue in March than in January. Why would that be? On a cash basis system, why would we have more revenue? Well, if we go back to the balance sheet, this is going to be one of those timing differences. If I go back to the balance sheet over here, I'm going to change the date up top from 12/1 to 3/31 and run that report. And then scroll down. You'll note that on an accrual system, we had $20,500 that was in accounts receivable as of the end of December in our practice problem. So we had money that was owed to us as of the end of December. So that means it was earned prior to January, which is when we got the deposit. And then it went down to $1,267 in January. So that means that we got deposits, we got money. Typically, that's what that would mean. We got money. However, when we recorded the deposit in January, in this case, we didn't record the other side to sales because instead we recorded it to reduce this accounts receivable. When was the revenue affected? It was affected when we made the invoice that created the receivable, and that happened, let's say, in December. It happened before the January time period. Therefore, no revenue would be related to any kind of deposits in January from the paying off of this receivable. We would just decrease the receivable. When we go to this system, on our system, we recorded those same deposits, but we assumed on a cash basis system that we didn't record the cash until we got the deposit. We were assuming here we didn't really make an invoice. We're just going to wait till we get the cash and then record the sales at the point in time we get the cash. So under this system, we got the cash and we just recorded any deposit that we had at the point in time we got the deposit at sales. We don't have anything to do with accounts receivable because accounts receivable is an accrual account. So that's going to be the sales item. Similarly, with the cost of goods sold, if I go back to the balance sheet on the cost of goods sold and we go down to the accounts payable in the liability section, and we had $15,000 on accounts payable. So that means that we purchased something on account and we owed $15,000. That $15,000 went down to zero in January. When we paid it in January, then we didn't record the other side to cost of goods sold or an expense account. We recorded the other side to decrease in the payable. So, and when we purchased the item, in this case, we put it on the books as inventory, which again is another kind of accrual type of system. So that's going to be the difference there. So in our system here, we said, all right, we paid for, whenever we paid for something on a cash basis system, if we paid for inventory even, on a true cash basis system, we would simply expense it. At that point in time, we would just expense the purchase, and we're saying that we're going to make the sale in a close enough period of time that the timing difference is not significant to us. And again, you want to be, inventory is one of those complicated systems. That's why you kind of break away from a cash basis system most of the time, oftentimes because of inventory, because there could be timing differences. So in any case, there's that item. Then if we go down to the expense items, and these ones would be related whether we have inventory or not down here, you'd have similar kind of timing differences down here. So the bank fees are fine. They're going to be the same. Depreciation, this is an adjusting journal entry, so we didn't record it in January. These things would be due at the end of the month. So then we have the office supplies. Why did this one record in January here and not in March? Well, if I go into it, we see the type of form that was made, and we see it's going to be a check form. So we made a check here, but possibly it didn't clear the bank. So even though it's on a cash basis system, because we wrote the check, if we're dependent on the bank feeds, the check didn't clear the bank possibly because it was written in January 30th. So even on a cash basis system, because this is a cash basis system, in January we wrote the check and recorded the expense when we wrote the check on a cash basis system. However, there's still a timing difference between when the check was written and when it cleared the bank. And therefore, if we're completely reliant on the bank, we don't have that yet. We don't have it until it actually cleared the bank on the system. So it's going to be in our books at the point in time it clears the bank rather than when the check was written. So that's going to be the supplies. This one's on both sides. Then we have the payroll. So if we're talking payroll expenses, same kind of thing. The check or expense went in as of January 31st. And that would be, if it was a cash basis system, the expense, remember, would be decreasing the books, but it didn't clear the bank possibly. Possibly, in this case, it didn't clear the bank. So on our side, we're still on a cash basis system, but we lag even further, a little bit further even, because we have to wait till something not only is on our side on a cash basis, but until it actually cleared the bank, which could be a little further out. So that's going to be the difference there. So that's going to be the same. So we have the payroll, then we have the repairs and maintenance, then we have the telephone didn't show up. Probably the same thing. We have the expense on the books at January 30th, and especially if they were checks that were written, it's going to take some time before they clear the bank, and if we're dependent on the bank to record the transaction, we're not going to be recording the expense until the point in time that it clears the bank. So that's going to be the difference there. If we go back up, and that's going to be, and then the utilities we did pick up because that one did clear the bank. And so that's going to be our major differences. Now, these items here that we didn't see, we would expect then them to clear the bank in February. I mean, well, yeah, here they would clear the bank. They were clear in February. In our case, the same transactions, because we're going to mirror the same transactions on a cash basis, will clear the bank in April. So in our example here, we would expect then to see in April, we would expect to see the payroll tax and the telephone expense and the office expense. So notice what the problem is, or what the difference is. Not really a problem, it's just a difference, is a timing difference, right? Here it would have been reported in the first month. It would have been reported in March if we did the same system. If we're waiting till it clears the bank, we're on a cash basis system, and we're on a cleared cash basis system, right? We're waiting until it actually clears the bank, which in our case is going to be in the next month. So we would expect to see those items then showing up in the next months as they hit the bank account, and we'll see that in future presentations.